Hello everyone, welcome to today's US Open live session, 10 minutes before Wall Street opens. It is Tuesday, February the 20th. I am your host Nikos Zabouras, Senior Financial Editorial Writer at FXCM. The US dollar is facing pressure as US traders return from the long weekend, and Wall Street is also under pressure. In the spotlight today was the rate cut by the Bank of China in order to support the ailing property sector, whereas just earlier we got inflation figures from Canada. And also in the spotlight today was Barclays Bank, which jumped around 6% after its quarterly results and an overhaul plan. Before, however, we begin, as always, please read carefully through the risk warnings and the disclaimers. Once again, please read carefully through the risk warnings and the disclaimers, and bear in mind that anything discussed in this session does not constitute investment advice and should not be taken as such. And with that said, let's get the ball rolling. We're going to start differently today. We're going to begin with the Hang Seng Index, or rather FXCM's CFD, the HKG33, and talk about the impact of the Central Bank of China cut of the 5-year loan prime rate, which affects, of course, mortgage rates in China. Then we're going to turn our attention to the USD versus the Canadian dollar, because we had the CPI print, the inflation figures from Canada less than an hour ago. As always, we're going to talk about the euro dollar and the Nasdaq, the Nas 100, and we're going to round things off with the quarterly results of Barclays, the UK bank. So on the China front, the central bank cut the 5-year loan prime rate, the LPR, which impacts mortgage prices. It was by 25 basis points, which is a forceful move and the biggest ever since this reference rate exists. And this may be indication that Beijing will ramp up its efforts to prop sentiment and demand of the troubled property sector, and potentially generally to support the bumpy post-pandemic recovery. The property sector has been hit by the pandemic, and authorities are trying to limit excessive borrowing. Evergrande, who is the poster child of this property crisis, was ordered to liquidation earlier in the year, while the IMF, the International Monetary Funds, expects further decline in the housing demand. Of course, the 1-year LPR was unchanged, and this is what affects most loans in China, while further stimulus, especially on the fiscal side, is likely needed to support the real estate market and the economic recovery overall. The piecemeal approach to supporting economic activity and the real estate market has failed to help stock markets. The Hang Seng Index, which we see on the chart, has dropped more than 10% last year, and it remains in a precarious position, as we can see on the chart. Now, the news of the rate cut supported the index today, which as you can see is above the 200 period EMA, and this brings the highs from the beginning of the year at around 17,139 in the spotlight. However, because of what we described, we are not very optimistic about the prospects of the Hang Seng Index. And in fact, the rate cut may help the property sector, but it could put pressure on the profitability of banks, which with financials being the biggest sector of the index. So we can understand the importance of such a development. The index remained in a precarious position, as we said, despite the recent recovery effort, and we can see a return back to the February lows at 1.0722. Although the multi-year 2022 lows, the next support remains a bit out of touch, let's say, for now. Now let's turn our attention to Canada and the inflation figures you got earlier. Let's say first of all that the Bank of Canada had maintained rates for the past 4 meetings and has hinted that at 5% the terminal rate has been reached, removing prior reference for further hikes. However, it called for a restrictive stance and dismissed rate cut talk, remaining worried about inflation, which had accelerated to 3.4% in December, as you can see on the chart. However, today's data showed a moderation below the 3% threshold, and in general, the figures were better than expected, less high than expected. And of course, this could help the Central Bank of Canada to stay on the sidelines, and this puts some upward pressure on the US dollar versus the Canadian dollar. The pair has the chance now to push for higher highs. The current located at 1.3506, although fresh impetus would be needed for challenging the next major resistance at 1.3783. On the other hand, the inflation figures will likely not do much to alleviate the concerns of the Bank of Canada. And on the US side, markets are coming into grips with a more conservative rate cut path by the Fed. The pair is in a precarious position, and we can see a test of 1.3357, but the 2023 lows at around 1.3091 look distant. As we've said, the US dollar faces pressure today. You can see that on the chart as US traders return, and in fact it has been under pressure for the past few days, and that may limit the USD CAD ascending opportunities. Of course, if there are any questions or opinions on what we discuss, feel free to type them in the chat box. And now let's go to the euro dollar, which is taking advantage of the greenback's demise today and extend its recovery from the 2024 lows, trying to take out the pivotal 200 period EMA, the black line that you see on the chart. Now, this right here is a critical point, because daily close above it would pose the downside bias. Now, on the other hand, the upside continues to look unfriendly, with a daily Ichimoku limiting, providing a significant roadblock. and the 1.1017 handle continues to look distant. On the other hand, the ECB has a more dovish rhetoric compared to the Fed, which could put pressure on the common currency. And a look at the RSI already shows overbought conditions. You can see that on the bottom of our chart on the RSI. And as such, we can see renewed pressure, and we can see actually lower lows at 1.0694, but sustained weakness below the 1.0.634 handle definitely has a higher degree of difficulty. For the time being, technically, the crucial part is whether we're going to get a couple of daily closes above the 200 period EMA, which would pose, as we said, the recent bearish bias, but with the RSI at overbought levels and generally multiple roadblocks ahead, the upside may be limited. Now, the tech-heavy NAS 100 is facing pressure, returns from the long weekend pressured, and is in risk of breaching the 200 period EMA, which is currently located at around 17,350, as markets come to grips with the prospects of less hikes by the Fed. Markets have priced out a May or a June cut, or a March or a May cut, and looking to the beginning of lowering rates starting in June and resulting in 100 basis points of cuts, much more conservative than previous expectations that it would go to around 150 basis points. On the other hand, it's hard to see sustained weakness for the index, with the daily Ichimoku, a thick ascending daily Ichimoku, providing an area of support starting from around the 17K mark. As long as this pullback is contained by the 200 period EMA, it is a limited correction that will allow the index to push for new record highs and tackle the 18,264 handle. Of course, a lot is going to ride on the results of NVIDIA on Wednesday after market close. We've already talked about it on Friday, and we're going to touch again on the subject tomorrow at our session tomorrow on Wednesday. And let's talk a little bit about Barclays, the UK bank, which announced its latest results in the morning. It plans to slash costs by £2 billion by 2026 and also announced a resegmentation of its business. The overhaul and saving push comes after its pre-tax profits fell 6% in 2023 to £6.557 billion. Overall income rose 3%, but income from the corporate and investment division fell 4%. Markets liked the news and sent the stock higher. You can see that it gains around 7% and has moved above the 200 period EMA and now targets the descending trend line from the 2022 highs, which is currently located at around 167. A break above it will bring in the spotlight the 2023 highs at around 193.18. However, the RSI moves to overbought territory, and as you can see, previous visits above 70 or at around 70 have on the RSI have led to an actual pullback in the stock. As such, there is scope of a return below the 200 period EMA, but strong catalyst would be needed for the 2023 lows to be breached at around 182.12. Now, that's pretty much it from me for today. Coming ahead, the biggest event, let's say, is for me in terms of US markets, Nvidia's results, which are due on Wednesday night, and we're going to have the chance to talk about it more extensively.